get started. So I'm Dana Markland with the Home Building Association of Richmond. And if you watched the news this morning, you saw that mortgage rates fell for the first time, or not rates, rather applications. Financial authorities like the Wall Street Journal continue to remind us that this new American economy is so challenging because there is no historical benchmark, of course, right? You all know that in HBAR, we have internal data, and what that has shown to us over the past 2 months is that new construction and remodelers by design are actually decelerating sales to manage volume and also to mitigate risk amidst such financial material price increase volatility. So the million-dollar question is really, what can the new construction industry, the remodeling industry expect based on the influence of mortgage rates and looming inflation? So this morning we have this expert panel from Towne Bank with us to talk about what to expect. Of course, no one has a crystal ball, but we have these great partners here to illustrate for us, the best expectations based on the knowledge that we do have. So we have Nate Smith, Vice President of Mortgage Sales, and also president of the board of directors at the Richmond Mortgage Bankers Association. Chris Bushing, who is the national renovation manager at Towne Bank. He is the authority in remodeling and renovation there. And Melina Lacey, who is senior vice president of Mortgage Corporation Underwriting. We are in fact recording this session because we had so many members who were interested in this information, but unable to make us join us this morning. So just so you know, we are recording, and we will post this on our YouTube page in the next day or so, so that we can share this feedback to the rest of our membership. So Nate, I'm going to turn it over to you. I suggest this a dialogue, and if you all have questions in the meantime, you can submit that via chat, and I'm happy to flag that for you, or go ahead and just raise your hand.
Awesome. Well, thank you, Dana. I appreciate it. Thank you, everyone, for your time this morning. I don't know that I'm a subject matter expert in anything other than maybe pro wrestling. I'm happy to share what I have observed over the last few months, articles I read and so forth. I do have a couple of subject matter experts with me, though, so a lot of things may get deferred over to them. But I thought I would just start off with some brief comments and then turn it over to Chris or Melina and let them talk as well, and then in the hopes that we can get some dialogue going, and we would love to hear what you guys would love to hear. But 2020 was different for everyone. The mortgage business was no exception. We saw hedges, which are pooled together loans, become worthless. We saw government loan pricing for a 2-month period just become utterly volatile, and you could see rates in 2%, but you could call somebody and see rates at 4% the same day, and that was mainly due to the CARES Act. We saw credit freeze up, only to thaw later, and then we saw the rates push lower thanks to the government, and in reaction to that, we saw one of the best mortgage markets we've ever seen. Demand being so high, we saw mortgage companies get pushed to the brink with that volume, all while working from a home mandate. So putting everybody who used to be working in an office in their homes. There's just a lot of different hurdles that we face. PPP loans for self-employed, and we'll touch more on that in a little bit. Fannie and Freddie imposed a 0.5 point charge for refinances with really no forewarning. We saw the housing market on an absolute tear, and so it's been a really interesting year, and we're in the lending business. We're dealing with a lot of stuff, but I know you in the building community are as well. Based on some of the conversations I've had, the articles I've read, I've seen, work from home mandates, labor shortages, supply issues here, recently gas prices being an issue. So I know that you guys are facing a lot as well. But overall demand is great, right? So let's talk a little bit about interest rates. You know, it would be great for me to be able to tell you exactly what the future holds, what tomorrow's rates will be, next week, next month, next year. Unfortunately, you know, there are so many things that are at play when talking about interest rates. It's hard to give that kind of prediction. Now, CNBC just reported for the week ending May 26th that the average conforming loan rate was 3.18, which is a slight increase from previous weeks. Now, 3% or pretty close to it, doggone good rate. The Mortgage Bankers Association, the MBA, anticipates that rates are going to rise to 3.6 in the third quarter and 3.7 in the fourth quarter. So we're looking at a potential increase over the next few months, but you know, still sub 4% interest rate. So overall, I mean, it's a great situation. You know, and I think one of the key pieces to think about when discussing interest rates is not only interest rates, but also the cost. And if you see a cost increase, let's say for a $500,000 home of say 10%, I mean that's you go from a $500,000 home to a $550,000 home. That's a pretty large increase. Now I've got a couple of slides and as it relates to this, but I'd rather keep it again kind of informal and more along dialogues. But you know, if you have a $500,000 home, 20% down payment, and you have a 2.75% interest rate, and that interest rate moves to 3.5%, that cost is approximately $165 a month to that borrower. 10% increase on that, the home goes up to $550,000. If you're looking to put that same 20% down, well, now you got to come up with 10 grand more. You got to finance $40,000 more. And even if rates are, say, flat and at 2.75%, that cost increase is $163 a month approximately. You know, you can see that, you know, there's more than just interest rates that really play into this. But rates do fluctuate every day. Heck, they fluctuate every minute. And so a quote from one person one morning could be completely different than a quote from that same person that afternoon. So it is really important to know that data comes out every day, every hour, every minute that impacts interest rates. So it's important to really have a reliable source and somebody you can call and talk to about that. They should be able to tell you a little bit about what the market has done, but you know, some of the releases as far as information goes that could impact interest rates. I don't have a crystal ball on that, but I can tell you that Mike Fratantoni, who is the chief economist for the MBA, you know, he's a fairly astute guy, very smart. I've listened to him speak several times. He is a big proponent of thinking that rates are going to climb, and I agree with him mainly because, you know, you can't have money just pour into the markets and there be no reaction. So we're going to see some reaction to all the federal stimulus. I think what we really need to pay attention to is going to be inflation and really vaccines. And it's funny, we talk about vaccines on a local level, but I'm talking about vaccines from a global level. You know, what's happening in Canada and Mexico and the UK and over in Europe, that's actually really going to be important moving forward because, you know, if you're getting supplies if you're getting marble from Italy, you want to make sure you can still get it. And those marble masons and professionals can get it from their quarry to the boat, from the boat over to us. So, you know, I'd love to talk more about interest rates, but I want to touch on a few different things. One being, you know, loan programs. There are lots of different types of loan programs out there. And not only that, you got loans that are are sold on the secondary market. They're securitized and bundled together. Those differ than bank loans or portfolio loans. Some of the loans that are sold on the secondary market, you're talking about Fannie Mae and Freddie Mac. That's probably terminology you've heard before. FHA, VA, USDA, Virginia Housing. Each one of those programs has different criteria for its qualification and approval purposes. Debt to income ratios, down payment, how they approach the analysis for self-employed people, and how they approach the analysis for even student loan debt. These differences can make or break a loan, and it's really important to know. There are different types of loans out there. I wouldn't expect a home builder to recite the 4000.1 FHA single family handbook, but they should probably know someone who can. The flip side to agency loans or loans sold on the secondary market are portfolio loans. And those are loans that are not sold on the secondary market. They're held by the institution that's lending them on their books. These loans may have different terms, may require a large down payment, may have a higher credit criteria. Oftentimes they don't have fixed rates, but are rather an arm. But they're not sold on the secondary market. And a couple of examples of these would be construction loans or bridge loans. Because of those, in both of those examples, they're very short-term loans. So it'd be hard to bundle and securitize and sell those. From a qualification standpoint, I just touched on that, for each of those different types of loans. It's really important to know income, assets, debts, and credit. That's really what we look at from a lending standpoint. Each one of those components is very crucial to the approval process. Does your customer have the credit score needed for the type of loan they're going after? Is your customer self-employed? How do they derive their income? Do they W-2 themselves, or do they use a K-1 to illustrate income? Does your consumer carry debt? What types of debt do they carry? Is it credit card? Is it automobile? Is it student loan, installment debt, spousal support? Even certain types of loans will look at childcare, the cost of childcare as a monthly obligation. And each institution can vary its process from a loan application to a loan closing. But I think we're all trying to get to the same place, and that is have a loan that's clear to close and ready to be funded. Some institutions may underwrite upfront before the loan gets processed. Some do the more traditional method of processing a loan prior to being submitted to underwriting. But overall, we want to lend money. When you're building a home, that process, it may take 7 months, right? Well, if you want us to look at your applicant prior to digging a hole, which I strongly suggest, then you might want to know that we're going to have to maintain a purview of their income, assets, debts, and credit for the next 7 months. So any variations in there, again, can make or break the mortgage. But I've just talked quite a bit and hit on a lot of different topics. Are there any questions?
Nate, I'll kick off with questions if you don't mind.
Sure.
From a builder standpoint, there's a lot of education that realtors provide a buyer. And what we're starting to hear is realtors, no one in particular, but just general feedback that they're telling buyers in the next 5 years, we could see mortgage rates bounce back to where they were in the 1980s. And that is starting to scare some buyers and perhaps influencing their, interest in a new home purchase today. Mm-hmm. Do you have any indication that we could see such a climb in mortgage rates to that region of a rate?
I don't. it's entirely possible given the amount of money that, again, that is pouring into the economy. But I think a lot of things would have to happen for that to escalate that far.
That seemed extreme to me, so that's
Yes,
why I
yeah,
asked.
and you're always going to have economists that are alarmist, or they might gravitate towards the negative. So sure, it's possible, and that probably is helping some demand out there. But I think that's the biggest thing is we can't seem to build them fast enough or sell them fast enough right now. Did that answer your question?
It did.
Okay. Any other questions out there? No? All right. Well,
I have a quick question.
yes.
So how do you advise a buyer in today's market kind of differently than normal, where some of the builders I talk to are selling into, next year at this point? So the build time and close time, I mean, you're looking at late 2022, in a rising kind of material cost, so sales price.
Mm-hmm.
How does that differ than when, I feel like last year you were looking at a 5-month build close time?
Great question. The protracted time frame, it's hard to advise somebody what interest rates will be next week, let alone next year. We can put some things in place and have conversations, but it's important to educate that consumer that, if you have any material changes in your income, your assets, your debts, or your credit, you may not qualify for the same loan program today, 12, 24 months from now. So it may be good to have option B or option C and make sure that they understand the different avenues. And it may be a good conversation to have as it relates to interest rates and extended locks. Now, generally speaking, we don't have an extended lock program that will protect that interest rate for the next 24 months, but we do have some that are 180 days up to 360 days. So there are conversations to have for sure, but that is one thing that we're uncertain about, and I know the builders are uncertain about is this cost of materials and what does that really mean to the consumer. If lumber's up 3 times the cost that it was 12 months ago, and you can't quote lumber, or your lumber quote that you get is only good for a week, that's a hard conversation to have, and I'm sure it's hard for the consumer to understand.
So Nate, you started to address it. We had a question come in. I'm not sure if you saw it in the chat, but may you address the appraisal issues, which aren't capturing the true increased cost of the build, which you just started to touch on, sometimes affecting a customer's qualification and cash needed. So is there anything else there?
Well, at this point, I'm going to turn it over to a more qualified person. Melina, would you like to touch on that?
I sensed that handoff coming. So that is a great question, and it's something that we've been addressing head on for some time. So let me give you a quick little verbal resume on me. I don't believe, other than Nate and Chris, I have met any of you. So I have been in this business for over 30 years. My entire family is immersed in this business. So I have loan officers, bankers, realtors in my immediate family. My grandfather was a builder. I live, breathe, and eat all of this. This is what I know. And I am not a salesperson by any stretch of the imagination. I am a problem solver by nature, but because I have such a close proximity to so many sales folks, I'd like to think I have a special sensitivity to what it feels like from that other side as well. So with that said, we, over the last, I'd say 12 to 15 months, we've seen I've never seen so many low appraisals in my life. And one of my responsibilities at Towne, so as a corporate underwriting manager, I have oversight over all of our underwriting staff, which of course our underwriting staff are reviewing appraisals. It's my job to keep them abreast of, agency, regulatory, investor guidelines, any changes within the industry, coaching, counseling, and my favorite of all things, auditing. When we have issues or we maybe don't get something quite right, it's on me to kind of analyze it and make sure everybody understands how we should do things better in the future. So all of these low appraisals coming in, we kind of expected that this would happen for various reasons. From the building perspective, of course, there's been an increase in the cost of building materials and a delay in getting those materials. So construction and completion of construction are held off. And of course, the longer something sits, nothing is good the longer it sits. And that, applies to, your property, your borrower who is currently qualified, but will they, stay qualified down the line? So as far as appraisals are concerned, and I think I saw the actual question kind of pop up in a little ghost image there. So I could build a house today that is, the ABC model. It's pretty vanilla. There aren't a whole lot of changes or customizations to that property, and it cost me $400,000 in January to build. And 6 months later, that very same property, essentially, no real changes, maybe cost $430,000 to finish that property before all was said and done. But I'm in a time frame where the comparable sales that are available to me were those properties that closed at 400,000, right? So how do we bridge that gap? So the unfortunate and quick answer is that we can't always bridge that gap. But obviously the market is in most cases, it's trending in the right direction as far as values are concerned. And it certainly, most markets can be deemed as increasing markets versus stable. And our appraisers do have some wiggle room as far as discretion and the values that they can bring in for, a new property that they're looking at today. So we actually had a really good forum. We've been trying to be as proactive as possible to have conversations with the people that matter to this whole transaction. So I brought many of our staff roster appraisers that work together with Towne Bank. They're not part of our company, of course, but they are part of our roster and independent appraisers that we've consistently done business with over the years. They are trusted partners, and my underwriting staff, so that we could all have a conversation about all of these things that we are seeing. How can my underwriters better understand how the appraiser put the appraisal together, and what options do we have available to us to assist in bringing in the sales price whenever possible. And it was a great conversation. Our realtors definitely shared with us that timing is everything. If I could drive home any point about the ordering of an appraisal, I'm not sure what roles everyone on this call holds, but between realtors and sales managers and site managers for builders, if you know that there's a property, that is scheduled to be completed next week, it may be critical or beneficial to everybody to say, well, I was going to order the appraisal today, but I know that, there's two units down the street that are going to close. Closed sales are what we need to bring in value. Pending sales really only drive trend. They help to establish where the market is trending. And so it assists the appraiser in saying, I'm going to lean forward in my value. I'm going to be justified in stating that, yes, the value is a little bit greater here versus, where it was 3 months ago or 6 months ago. So identifying those comps and providing information to the appraiser, whoever that point of contact is, typically it's going to be someone on the builder side when we're ready to order an appraisal or a final inspection. Know your subject property and really give that important information to the appraiser. Appraisers are no different than the rest of us. They if I'm having a conversation and Nate starts it off with me and he's super positive and excited about it, I'm going to start off super positive and excited about it. So drive that narrative with the appraiser, let him know everything that is special or unique or awesome about this property if you can, and provide him with that list of sales that you personally already identified that you feel like support the sales price of the subject property. Those were the two most important tips that the appraisers shared with us during our forum. I can tell you that when there is a situation where, you know, we ordered the appraisal and the appraisal was completed, you know, the day that the appraiser goes out to your property is the effective date of your appraisal. And any sale that happens after the effective date of your appraisal is really not relevant to that appraisal. It's unfortunate because, you know, from a common sense perspective, you're like, no, like this house and this house, they just closed. But we need to understand that an appraisal, a real estate appraisal is really a measure of value, and it's a snapshot. It's just that moment in time. It's not meant to be a continual evaluation. You know, for practical reasons, you know, we say an appraisal is good for 4 months, but really that tells me what the value of that house was on that day. So the timing of that inspection couldn't be more important. Before I ramble on, because I could ramble on forever, does anybody have any questions? Yes, Nate.
What do you do when the value is low?
So we have some options when the value is low, and as luck would have it, so we have a process at Towne for reconsideration of value, and the process is very different depending on your loan type. So if you're conventional, FHA, VA, there's going to be very different requirements that are not our rules, they are agency requirements for how we handle that process. I will tell you that conventional is the most simple process. VA is absolutely far more complicated, and it is not an in-house process. With VA loans, we're going to have to gather our information together, make our case, and submit our request to the regional loan center of jurisdiction, and they get to make the call. I do not make the call. As far as a conventional loan, so if you or, you know, any person who is a participant in the transaction feels that the value, you know, that you have a rebuttal, whether it is an explanation and a narrative of why you think certain features of the property weren't adjusted properly, or you have additional comps that are available, you can present them to your loan officer, your sales manager, to Nate, and those will flow through to our underwriter. He or she can analyze them. And then present them to the appraiser to see if we can in any way shift his opinion or her opinion of the value of the property. We have to tread very carefully. Of course, there's appraiser independence that, you know, is a hot topic in this industry. So I can't necessarily try to argue or convince an appraiser, but I can certainly make a case. And as a lender, we have a lot of really valuable tools available to us. Those two vary based on loan type, but I have access to various databases and analytical tools. Some I'm actually mandated to use, which is either a curse or a blessing, depending on you know, the transaction that I'm dealing with. Typically, new construction is the most difficult property type to assess through a model, because there are times that the model is confused, right? They don't even know that there's a house at 123 Elm Street because there wasn't last year. It was a piece of land last year. So that's why I am pleased that we have such a skilled set of human underwriters. And while we utilize all these evaluation tools, every single appraisal that comes through Towne is manually reviewed by a human. But nevertheless, so we get to that point where the rebuttal has been made, whether through narrative or additional comps provided. We present them to the appraiser. If, you know, we're looking at a conventional loan or an FHA loan, it would be pretty much the same. And we determine, and he comes back and says, I'm sorry, the value is the value. And certainly if, you know, any of my underwriters is having a hard time making the determination if the additional information provided really should move the needle or not, you know, they can come to me, they do come to me, and I can help determine if I think that there, you know, an adjustment is warranted. I'll give you an example of one that came across my desk the other day. And I think we have an exceptional group of appraisers that we work with. So this is not a knock against any of them. We vet that roster continually too. So if we're, you know, we've got, you know, staff members and a management system as far as an application that assesses, you know, turn times and the number of times my underwriters have to go back to appraisers to ask for corrections. response times, etc. So we're constantly evaluating our appraisal staff. So with that said, they are excellent. However, they are no different than the rest of us right now. Everybody is pressed. It's, everyone can't remember the time that we were busier. And of course, we can't remember the last time that some of these things that we're experiencing, we've never experienced before. So in this particular situation, the appraiser had rated the market to be increasing on page 1 of my appraisal. I'm sure you've all reviewed a real estate appraisal at some time. And then further on into the report, there is a market conditions addendum that's actually not required by anything except FHA and USDA right now, but most appraisers still provide it in their report. And on that report, I could see that it wasn't quite matching. So we assessed whether or not, do I really have a stable market or an increasing market? And he agreed, well, we have an increasing market. But I had comps that were 5 and 6 months old. So we identified comps that were 1 and 2 months old. And that wasn't really enough to get us there, because the most perfect comp that was present in that report really was 6 months old. It was virtually a cookie cutter version of the subject property. And so we determined that there really was a timing adjustment that was warranted for that perfect comp. And it got that needle we actually came up, believe it or not, and I argued, does $500 really make a difference on a $450,000 house? But I got almost there. So we started with a $20,000 spread, and I ended up with a $500 spread, and everybody, could kind of swallow that and go home and be happy. So that's a little bit of how the process works when we have a reconsideration of value. Yes, Nate.
Can't we just order a new appraisal?
I knew you were going to ask that. So the short answer is no, you may not, but it is possible. So the other good news is that the person at Towne who decides if we can order a whole new appraisal, if it's an FHA or a conventional loan, is Molina. VA does not allow us to just order a new appraisal. They would have to make the determination themselves. I've never actually seen it happen. What happens if we escalate a situation like that to the VA? The reconsideration of value happens at the regional loan center level, but that's only up to 5% of the value. So there's only 5% wiggle room. If you need more than that, they're going to assign this case to a staff appraiser from central office. It's kind of a pack a lunch experience at that point. It will not be quick. It's not measured in days. It's more like weeks or a month or more. And they'll send one of their appraisers out to actually appraise the property. That's what happens there. However, if we're in a situation with a conventional or FHA loan, or a portfolio loan, and we've determined we would like to order a second appraisal, the short answer to when we may is if I can determine that the existing appraisal is deficient, meaning I cannot rely on it to lend, and I've exhausted all of my communication with the appraiser. There are times, especially when we're in, outlying areas that we maybe don't do a whole lot of business with, that I might not have a staff appraiser that covers an area. In those cases, we have resources to, reach out and find someone to work with. And those times tend to be the times where I'm having a difficult time communicating with the appraiser. Most of them are wonderful, but every now and then you'll get someone who's, grouchy, salty, tired, whatever. And they just don't want to have those conversations, and they feel offended that they're being challenged with the work they perform. So I have a lot of experience in being delicate and sensitive, in presenting, our concerns, but occasionally we'll come to the determination, this is just not a good appraisal. And I have more than just my own opinion or my underwriter's opinion to rely on. Some of those tools that we talked about, the tools that we are mandated to use through various agencies are, all of them are equipped with big data, right? So they're constantly pulling information from the various markets, from MLS, from county records, from city records, from other appraisers. Every time an appraiser reviews a property, either, as the subject or is utilizing another property as a comparable sale, whatever the appraiser determines to be, the features of that property is fed into this system, and it's constantly being vetted and compared against each other for consistency. If I say this property is, C2 condition, which is a step down from new construction, right? And everybody else calls it C3. Well, maybe, I use that condition rating improperly. So there's constant checks and balances in place. So if I have gotten to a point where I don't feel that, the appraisal is solid, and I've got my tools and my big data to support my argument, and the appraiser simply is not willing to work with us any further, then I will make the determination that we'll order a brand new appraisal. In those cases, I always warn everyone, the receipt of a second appraisal, which might have a higher value, it's not necessarily a guarantee that we're going to rely on that appraisal. I'll always be relying on the best appraisal of that property. Generally speaking, that we hope that second appraisal is going to be better than the first, because we've already determined it to be deficient. But we do have opportunities to order a brand new appraisal. We do like to exhaust all of our efforts, though, whenever we can, to make sure that we are not unnecessarily setting aside an appraisal report or spending anybody's money, whether it's our money, the borrower's money, and of course there's a time factor involved in that too. Yes, Nate.
Sorry, I seem to have a lot of questions. So the cost of lumber doesn't really play into that, or how does it play into the overall appraisal?
Well, I mean, the cost of lumber plays into the appraisal, or it plays into the value of your property and the cost to construct, right? But unfortunately, if you priced out a property today and you don't have that inventory in-house, and by the time you're able to acquire it, it costs you more as a builder. I'm trying to think of a nice way to say that. That's not going to be, something that the borrower can probably absorb, or that we as a lender can consider. It is very unfortunate. And I know that, there's a pressure to be competitive too. We don't want to, start overpricing properties and not be, competitive with, other builders. But the cost of lumber needs to be something that perhaps is, forecasted and anticipated when the price point is set for that property.
Melina, so some of the builders are going back to their buyers who are under contract and explaining to them what this price fluctuation looks like, or increase rather, it's not really a fluctuation. How, from your side, are you all managing that, if at all? It sounds like perhaps it's not a factor, but when the builder is saying, these are our increased costs, we'll either meet you halfway, or we're asking you to come to the table and provide more cash, or we're giving you an out. How does that out factor into the process right now? Or are you seeing much of that is influencing your work?
So we definitely, we kind of had some conversations and provided some guidance to our sales staff a few months ago, regarding, anticipating what could happen in a situation like that. So, I think if the builder gives the borrower an out, if we've contracted to, build the home for X and it's not remotely financially feasible, and the borrower at that point wants to opt out, that doesn't really, affect, me and my staff from a lending perspective very much. However, if it's determined that you can come to, some kind of agreement, there's a happy medium, whether, I think that in those cases, you'll probably ratify a change order and increase the sales price for cause. And there should be a conversation with the borrower and the buyer that they may have to participate in that price increase. So we're going to do all we can to get an appraisal to come in in support of that sales price. And hopefully some, sales are, occurring during the construction that will help to get us there and support that. But they need to be prepared that, they may be bringing more money to closing. And that is something that, the communication should be open with our loan officers as well, so that we can have communication with our operations staff as well. So when a borrower, we've got many builders that we work with, and there's, each builder has a different way that they like to do business and how they like to move forward in the process. Some want more of a comfort factor than others. I think maybe it depends on your relationship with your sales partner. But we, from an operations staff, are always keeping an eye on our pipeline as well with regard to expiration dates. And there's a responsibility with new construction. I qualify today. I need to continue to qualify throughout the process so that I can actually close on that deal when the property is complete. So we are looking at expiration dates. We try not to unnecessarily burden the borrower to continually keep providing documentation over and over and over again. But if I have bank statements that, reflected that you have, X number of dollars in it, and it provides you with sufficient funds to close and maybe a buffer of $20,000. And now we've had that conversation that that you need it. Maybe I don't need updated bank statements, every 3 months right now, but Nate needs to have that conversation with the borrower as the loan officer and remind him, okay, so just a reminder, I show that you got 40 grand in the bank, and, we think you might need a little extra cash, as we've discussed, because your sales price went up. Are you still good, or have your assets remained stable? To keep having those conversations about qualification. Of course, if the change order is potentially, if the goal is that change order and the increase in the sales price will increase your loan amount, right? So you're looking to at least continue with that max financing and, the minimum required down payment. We need to update your loan file. So you qualified for a loan of $350,000. Do you still qualify for a loan of $360,000 perhaps, or whatever that number is? So we're keeping, our operations staff is keeping an eye on that as well, to keep the communication open, to remind everybody of what could happen, and to keep them qualified throughout the process. I can't tell you that it's never happened that, somebody decided to, go out and buy a fancy new car to put in that driveway that they don't quite own yet prior to closing. And, sometimes that is a big boo. But, it does happen. So we do all we can to keep everybody on track and keep them, focused on the prize throughout the process, so that when the closing day arrives, we can close successfully.
Well, I think if there's no questions further, Nate, if we could pivot to Chris, because a large portion of our builders also are in the line of remodeling.
Absolutely.
So it would be good to shed some light on what's happening there.
Sure. Well, with that, I'd like to turn it over to Chris Bushing. He manages and handles our renovation financing department, and he is the guru when it comes to needing funds for those upgrades and remodeling that house. So without further ado, Chris Bushing, welcome to the stage.
Am I good? All right. What's happening? It's kind of everything's working exactly the same way for us. What I think I would probably want to talk about is just, the bulk of my day is education. It's getting out in front of builders and realtors and the public and explaining what a renovation loan really is, and fighting, quite honestly, some of the past. So when we do a renovation loan, it's not for necessarily, that rundown, dilapidated property that needs a whole lot of help. We've got a bunch of builders on the call here. The renovation loan is for, doing that major addition, putting that second story on a property. Technically any property can be a renovation loan, and we consider a house a foundation. So if you have a foundation that you're building around, it's technically a renovation loan. Now, FHA technically allows you to tear a house down to the foundation and build a new house up, as long as you don't substantially change that foundation. Now, right now, because of the market, because of time frames, our investors are not really allowing that to happen. They don't want a complete tear down. You need to keep up some walls. But with a renovation loan, we can go up to a 95% loan to value on any renovations. So we were talking about, you guys were talking about combating appraisals. If you have that low appraisal that comes in and you no longer have that 80% equity or 20% equity in the property, one of the options might be, as long as you're under the conforming loan limit, switching that over to a Fannie Mae home style renovation loan, where we can go up to a 95% loan to value. That's on a refinance or on a purchase. When we do these renovation loans, we finance every aspect of the renovation into the loan. So all of the costs, permits, inspections, title updates, everything gets thrown in there. There's no out-of-pocket expenses on a renovation loan for your buyers. The other thing that I constantly have to fight is experiences that people have had with renovation loans in the past. I've been in the mortgage business for 25 years. I've been doing renovation loans almost exclusively for 22 of the 25. Historically, renovation loans would take 60 to 90 days to close, because what happened was you had loan officers trying to do these loans that they don't know what they're doing, and it causes major problems, delays in closing. And, we don't do it that way. Here at Towne, the way we do renovation loans is I handle the renovation side. I work with the builder, I work with the buyer, and then the loan officer and the processor work with the buyer on the credit side. So we work side by side, we meet at the end and we close. We're closing on average around 45 days on a renovation loan. The other thing is we hear a lot of builders and contractors complaining about how long it takes to get their money. That can definitely be an issue for you guys, because there is a process that has to happen on a renovation loan. But I will tell you, with Towne, if there's a delay in purchasing the loan, we will cut that first check if you guys are ready for your first draw, as long as we're not in the middle of selling that loan. So if that loan is not going to be sold in the next 3 or 4 days and you guys are waiting for that check, we'll go ahead and cut the check, and then we'll get it from the investor back later so that you guys don't get delayed. So we know, what your struggles are, and we are definitely trying to do everything we can to make sure that everything goes smoothly for you, because this is a really important product for us. And it goes hand in hand with the construction side. And, Nate will tell you I could talk about renovation loans for hours and hours, but I know we're already 45 minutes into this thing, so I don't want to. I'll probably just leave it at that and then open it up to any questions that anyone might have.
I have a question.
Yes, sir.
Is there a particular type of loan that you're seeing requests for come through on the renovation side right now, more so than others?
Well, you always have more requests for the FHA 203K, and that's because that's the one everybody knows. My own managers, will say, "Oh, Chris is the 203K manager." I'm like, "Well, I'm not the 203K manager. It's not the only product that's out there." But they usually start with the 203K, and then I'll talk to them about the Fannie Mae home style renovation loan, because they work exactly the same way. So a lot of times they're much better off going Fannie Mae, because the loan amount may be able to go higher, the mortgage insurance is always less, and the potential to drop mortgage insurance in the future is there. Whereas on an FHA, you're going to pay it at least 11 years. So they'll always ask about that. Yes, sir. Or her. Yeah, too.
My follow-up question is, are you seeing the same issues on the renovation side from an appraisal standpoint that we're seeing from a purchase money transaction? Where there's
you're going to have that issue. Everybody's overbidding. Now we see it less on the FHA 203K, because on an FHA 203K, you can actually go up to 110% of the after improved value. So we look at that after improved value, add 10% onto that. As long as your purchase and renovations come in under that 110%, we're good to go. And if not, then we'll go back to the appraiser and say, okay, what can we take out of this appraisal that will not affect value? you know, and then we maybe take out some of the bells and whistles. So they'll work with us on that prior to closing so that we can always make it work so that we can get in under that number.
Does
Melina?
the process work the same as a construction firm with the draw process and that same?
Yeah, it's very similar. Yeah, it's similar. The difference is I always tell people consider a renovation loan really what it is it's a cash out purchase. You're buying the house or the refi. We take the renovation money and we stick it in an escrow account. You are paying on that money from the beginning. So it's not like a line of credit where you pay as you take it. But that money goes into that account and then we release that money in draws, up to 5 draws, to the buyer and the contractor in a 2-party check as work is completed. So once they've completed, 30% of the work, then they'll call the HUD consultant. He'll go out to the property, inspect it, and then he will submit a draw request for anything that's been completed or the percentage of anything that's been completed. That's typically the way it works. Melina, did you still have something?
I did. So we were talking earlier about various loan programs. Nate touched on agency loans versus shelf and portfolio loans. Can you share with us a little bit about the products that we have available for renovation on the bank side?
On the mortgage side?
Right. So we also have like a portfolio product that will allow you to do some renovations as well. I think it's probably worth mentioning that there are some very strict agency guidelines that we have to contend with, but we do have some products on the bank side of things that allow us a little bit of latitude and discretion in the qualification process.
I'm just learning the bank side because I'm just joined with the construction team. So I'm probably not the person to talk about what the bank can offer. On the mortgage side, we offer both versions of the FHA 203K. We have the Fannie Mae home style renovation loan, and then we have our own scaled down version of a streamlined renovation loan that's conventional, that typically wouldn't be anyone that's using a builder because it's much smaller. But on the bank side of things, Nate might actually be able to speak more on that.
I wasn't trying to stump you. There's so much we could talk about.
It's easy to do.
We could probably all get together for lunch. But we do have bank products that, so, we have CP products on the bank side that the mortgage side participates in the underwriting of the loan files. And there are certainly everything that Chris has shared with you with regard to, the property and, the renovation side of things is essentially unchanged on the bank side. But we do have some latitude when it comes to, the credit qualification piece of things. When it comes to some of our bank products. And we didn't really get a chance to touch on that so much, but I think that's kind of what makes us special is that we have maybe a broader buffet than, some of our competitors. We have all the same agency products and investors that everybody offers for conventional FHA, VA, but we do have a suite of programs. In everyone's experience, you probably think of shelf loans and portfolio loans as one and the same. They are not one and the same here at Towne. Shelf products are banker referral products, and portfolio products are those options that we allow our general sales staff on the mortgage side to offer freely to our borrowers. So I really didn't mean to stump you, Chris, there. I know that they've just started kind of merging those two things together. It's been merged on the underwriting side of things, but maybe not so much on the sales side of things. But there's yet another tool in the renovation toolbox there available for everyone. So we've got a very good chance that anyone who wants to do some renovations has a product available for them. Nate.
Question for Chris. Just
Chris.
Let's see if I can do this one.
Just a general question is there protection for that consumer doing a renovation loan with cost overruns or, you know, the cost of,
Yeah. We're always going to have a contingency reserve. It's going to be a minimum of 10%. You know, if there's lumber involved at this point, you know, we may go 15. We're not allowed to go more than 20. But yeah, we will always hold a contingency reserve, and we're definitely, you know, going to look at that closer now than we ever have before. I mean, I very rarely saw more than a 10% contingency reserve. And the contingency reserve is typically determined by the HUD consultant. So he's an independent inspector who really is the policeman of the draws and all that stuff. He is typically going to be the one that holds that contingency or tells us what it's going to be, sorry. But if I look at it and I say, hey, Dan, you know, don't you think we maybe should hold a little more? You know, then, you know, he'll say, oh, yeah, you're right. Because he's been doing it as long as I have, the guy that I normally refer out. So, yes, but we will always have at least a 10%, if not a 20% contingency.
Nate, I'm not sure if there's additional questions. Do you all have additional questions? I do have one question, which may be a wrap-up question. So if anyone has nothing.
Can I ask a quick question of the group? I'm curious to know. I think anyone who ever picks up a newspaper or scrolls through their news feed online knows about the lumber issue. What would you say are the next most critical materials or inventory issues you're having? What else is super difficult to obtain right now?
I know we've got some builders on the line who can speak to this. Jordan, you may be a good authority to speak to it, but I know it's materials across the board. So I'm happy to answer, but Jordan or Sean in particular, would you like to address that from your personal perspective? Jordan says everything.
Yeah, that's what
Jordan yeah. What we're hearing from all of our builders is, you know, they're even trying to stockpile electrical wiring. You know, appliances, everything that is possible. You know, it's not just the framing lumber and the OSB, but even alternatives that we probably never would have thought of using, such as steel or concrete. Of course, those products are used in other areas of the country, but they've oftentimes been so cost prohibitive. And now not so much, but those materials are also on the rise. So, you know, I'm seeing in some of our homes builders using alternatives that would have never been fathomed before, just because of the price to value ratio. And we do have products that have, for the most part, been much more economical and just as reliable, but they're looking at all options and also stockpiling where they can. And of course, that applies its own set of unique pressures.
So kind of like the builder version of some of the other types of product availability issues we witnessed last year, like toilet paper and.
Exactly. That's exactly it. I just saw a funny meme recently that said it was gas prices said to lumber, hold my beer. But now that's really every material out there. And the volatility of the materials price increase is really having an impact on builder confidence. And even, you know, when we saw lumber prices increase just yesterday, and the past 3 to 4 weeks have created just an even greater uncertainty in the new construction and remodeling market like we have not seen.
Thank you.
So, and that does lead me to kind of a question that I have, which I think any one of you could answer. But, you know, in the news this morning, we did see that mortgage applications, I said rates, I meant applications, fell for the first time. Here at HBAR, our builders, as I mentioned, by design, have been slowing or de-escalating sales just in order to manage volume and reduce their risk with these price increases and this general volatility. What is the reason for the mortgage application decline? What is the factor that you all expect?
I think There are probably a couple of different answers to that. First being refinance demand. That has certainly waned. So that is going to, the less people apply for refinancing, the less mortgage applications there are. But I also think, reading some of the articles that have come across my screen for the last 2 weeks, we're seeing demand soften a little bit. I think we've reached the saturation point with what the consumers are willing to pay, at least locally, over and above that ask price, particularly for resales. So I think you're seeing some demand again soften there. I think some of them are just stepping away saying, wait a minute, this market is way too crazy. I can't afford $50,000 over what they're asking. I need to reevaluate my position. So I think we're seeing the mortgage application numbers dip because of that and refinance demand softening. Does that answer your question? Okay.
It does. Thank you.
And Melina or Chris, if you guys would like to add anything to that or tell me I'm wrong.
I would just add they can't find it. I mean, people are just frustrated. They've been looking for months and, they're just so tired of putting in that, the 10th real estate contract that gets rejected because someone came in $40,000 over asking price. And they've just so dejected that they just said, okay, I'm just done right now. I can't put myself through this anymore. So I think that has a lot to do with it as well. And like you said, it could only go down because it was so great. Applications were up so much over the last year. There's only one way to go. So it's going to be down eventually, but still great.
And I do think that, though applications are down, I think most lenders, I know that we absolutely do have a very significant, what we call a TBD pipeline. So we have borrowers who've made application, previously, maybe it was last month or 2 or 3 months ago, and they are qualified with us. They're lacking a property. They're still trying to win that contract, and the bidding wars and the creative contracts are beyond anything I've ever seen before. So there's the loans are there to be closed, but in a lot of instances they really are waiting on that property. As far as refinances are concerned, there are those people who are kind of in limbo with that as well. There was a sweet spot for them where it was worth their time at a 2.5% interest rate, and we're not really there right now. But there's still plenty of opportunity. I can tell you at Towne we have not really seen things slow down at all at this point.
Well, Melina, Nate, Chris, I know that we're past the 10 o'clock mark, and we're so grateful for your time and expertise on this. Is there anything else you wanted to cover? Otherwise, we'll say thank you so much, and we'll get this posted up as soon as it downloads to our cloud.
Thanks, Dana. Appreciate the opportunity.
Thank you, Dana.
Thank you.
See everybody.
Y'all have a great day.